Hi, welcome everyone again to another financial analysis video with myself, Moeed Amin, and Ted Wayman. We're going to be looking at AB InBev today. I think the first or maybe second of the drinks companies that we have done as an analysis in this podcast show. So before we get into that and some interesting things that we've looked at, regular things that we've looked at in the company. Don't forget to like, share, subscribe, especially if you've requested a video, you'll get the notification. So let's dive right in. So a new CEO for AB InBev, and they're the world's largest drinks brand. And they have several drink brands under their portfolio. So, you know, Beck's, Budweiser, Leffe, Corona Extra, etc. They have a new CEO which joined in July 2021. Well, not joined, but became CEO in July 2021. He's been in the business for a very long time. Michael Ducaris. What's interesting is that he's looking to sell the German beer brands that they have in their portfolio to the tune of probably about $1.2 billion. Now, that's still to be decided. You're not going to see that in our financial analysis today, but it is worth keeping a note of that as part of your investment thesis. Remember, as we say in all of our videos, this is just the retrospective, right? It's a backward-looking glance at the business, but it is an important one as part of your investment thesis. Quick points about the share price. They've been around, I think, since 2000, and it's been a bit of a roller coaster. If you invested 5 years ago, you would have lost money. If you invested 1 year ago, so around October of 2020, you would have lost money, but it would have gone through a bit of a roller coaster. So there was a point where there was quite a high peak. So as with the stock prices, timing is everything. So we'll go into that later on. So stick around and you'll see some of the details around that. So Ted, let's dive straight in. What have we found about AB InBev and this very large brewer?
Well, thank you very much, Moeed. And yes, very good to see you. This is obviously our second company. The first one we looked at was Brewdog, if you remember. You mentioned like, share, subscribe. This is obviously at the request of one of our subscribers. So Matthew Newport Jones, this video is for you. You also mentioned that this is very much a backward-looking video, and I will reiterate that if somebody says to me, you know, you're not looking at what's happening in the future, well, no, this is financial analysis. We're looking at the financial statements, and they will tell you what happened in the past. And as you and I know, the past performance is no guarantee of future performance. And also one last caveat, Moeed, while we're there, timing is everything. But timing is a mug's game. A mug, if you think you can time the markets, then I think that you are kidding yourself. Very few people are able to time the markets. And therefore, really what we're looking at is a fundamental analysis. If you like the shares, if you like the stock, if you think the numbers are adding up and everything else adds up, then invest and ride the waves. Okay, long-term investing. This is not a forum for day traders and high-frequency hedge funds. Okay, so with that in mind, here is InBev, and this is their annual report for 2020. So a little bit out of date now as we're getting into the kind of the last part of 2021. It's now October, but still, these are the numbers, the latest set of financially audited numbers. And like any audit report, you will find lots and lots of information. So lots of information about the company, about its performance, about the kind of breakdown. Most of this will be very much kind of, you know, the spin on there, the company giving you the kind of the positive story that they want you to take away. But we are going to be going right the way through and looking at the financial statements. So the financial statements for InBev are on page 25 of their accounts. So first thing we see is top line, looking at the revenue. The revenue has fallen from 2019 down to 2020. Now, there's a number of different reasons why the revenue might have fallen, but I think that the reason for this is contained a little bit further down when we see that they have actually they've sold a business. So they're actually they sold a part of the business, and that's why it's fallen. So rather than just shrinking market share, this is part of their ongoing changing strategy. And as you mentioned, there are other parts of the business up for sale as they try and exit certain parts and move into other areas. They're still profitable and they're making a very high margin. So this is a 60% margin business. So bear that in mind. Every time you buy a beer, you're not buying the beer, you're buying the brand. And that's really what these guys are in. They're in sort of, producing a product, whether it's a beer or a whiskey or whatever it is, and then making sure that the brand and the value of that brand is reflected in the price, and getting us to pay a kind of a premium price for what is essentially a pretty standard underlying product. It's all about the brand here. And because it's all about the brand, you'll notice that they actually highlight the sales and marketing expenses. So they've actually given you a kind of the distribution expenses are relatively high, sales and marketing, and that will mainly be marketing and advertising and the kind of the sponsorship. For example, think about premium drinks, sponsoring a premium events, sporting events, etc., etc. And they split that out from the admin expenses, which is just the kind of cost of running the business: rent, rate, light, heat, finance team, HR team, facilities, IT, all those kind of, those normal costs you'd usually see. And then, these distribution expenses, again, quite a lot, because, physically they've got all these bottles of beer and so on and so forth, and they need to be shipped around the world, and that's pretty expensive. Anyway, so what do we come down to? Operating profit, pretty profitable, a nice kind of 20% in this year, down from 30% in the previous year, and that's probably because the costs have come down, but this is really a kind of a fixed cost business. So these are the fixed costs, and you've got to pay them whether you're running lots of brands or only a few brands. So we have seen the operating margin has dropped from 30% down to 20%. This impairment, just worth identifying this impairment of goodwill. So goodwill arises on the acquisition of another business. So this is where you buy another business, and these guys, they've bought other businesses, they've bought other brands effectively, and when they buy those brands, what they're really buying is the brand, and that's the value that's effectively the difference between the net asset value and the price that they've paid. And obviously this is reflecting some of the brands that they're not happy with, and that they've actually reduced that goodwill, so they've taken a hit. So these numbers here really kind of represent a kind of a one-off. You'll notice restructuring, which basically says redundancy. They've got COVID costs in there. They've got this impairment of goodwill. They weren't in there last year, and they're not expected to be in there next year. So this is a one-off. And so they're trying to get down to this profit and operations before, and they've highlighted these non-recurring items. Now, I always get a little bit nervous about non-recurring items, because often you find that the non-recurring items tend to recur on quite a regular basis. But I'm reasonably comfortable that these guys really are talking about non-recurring items. It doesn't look like they're going to be, again, you can see the restructuring is kind of almost the only one which is on an ongoing basis. But there's not going to be that much restructuring going on into the future. So scrolling down to the bottom half of the income statement, they're profitable, they're generating, they got quite a lot of finance costs. That means that they're carrying quite a lot of debt. And what we'll probably find when we look at the balance sheet is that they've used the debt in order to buy, in order to fund this acquisition. Yet they can still afford that. The debt looks like the debt has gone up, but the debt, even compared with the profit from operations after the one-off costs, is, they're still able to afford that debt. However, we don't want to see interest rates going up too much. We might compare that to the original the underlying operating profit. Again, it's even more healthy. So bottom line, they're profitable, but they were nowhere near as profitable as they were in the previous year, mainly because of things like that write down in goodwill, the fall in the the shrinking of the business through disposal of a part of the business. So here we go. There's the profit from discontinued operations. So this, I think, reflects the fact that they have sold part of the business, and that's why their revenue has shrunk effectively. And paying a little bit of tax. So they are profitable, but they are not nearly as profitable. They've dropped from a net margin of 20% down to 5%. It looks like there's a bit of kind of just restructuring going on in the business, and once they get through that, they then just stop, consolidate, settle down. That last piece of business that they're looking to sell goes, and then they start to kind of really make sure that they can kind of return to the original levels of profitability. And you'll probably find that these numbers are reflected in the financial statements. Sorry, in the share price. So there's the income statement. If we carry on down to the balance sheet, this is the statement of financial position. So in terms of the balance sheet, the assets, the non-current assets, these are the things that we need to run the business. About 200,000 million. So that's 200 billion of assets. So that's, pretty, give you an idea of how big they are. It's a pretty big number. And we notice the biggest number easily is this goodwill, and the goodwill, as we mentioned, arises on acquisition. When you buy a drinks manufacturer, you're buying the brewing site and so on and so forth, but what you're really buying is that brand, and so you're paying a premium for that brand. You're paying for the income it generates, and therefore a lot of goodwill is generated. So they've got a lot of this goodwill. They've got some other intangible assets. Note 15 will tell us what they are. Probably things like licenses and patents, for example, and a little bit of property, plant, and equipment. There it is up there. So that's the actual sort of physical assets they have for producing their drinks. Down in the current assets, we noticed a lot of cash. So 15 billion of cash sitting on the balance sheet, which gives them a pretty strong balance sheet, certainly up from the previous year. And you'll notice that a lot of that will be driven by these assets held for sale. Effectively, they've sold them for cash, and now they've got that cash. They can use that either to continue to expand the business, or they can use it just to kind of fund existing operations. But overall, looks a pretty strong top half of the balance sheet. Interesting enough, if we go to the bottom half of the balance sheet, and while we do that, just remember this current assets of 26 billion, which you can see up at the top of the screen. If I just shrink it down a little bit so we can actually see that. So the 26 billion up at the top of the screen, which is the current assets. Quite often we compare that to the current liabilities, and the current liabilities, 32 billion, suggests there's an issue around liquidity. Now, this business, it doesn't look like it necessarily is a kind of a naturally strong cash flow business, but what is interesting is that these guys have very, very high payables. So this number here is incredibly high, and suggests that they're not very good at paying their suppliers. Now, I don't know whether that's the actual reality, but certainly I get the impression that these guys are using a bit of their negotiating power. It's a big company, and they just say, look, we're going to pay you in 120 days or 180 days, in which case it allows them to operate at that low liquidity ratio, that low ratio between the current assets and the current liabilities. Nothing else really jumping out in terms of their balance sheet. You'll notice that they've got some current debt as the short-term debt and some long-term debt. So there's the long-term debt as we expected. So they've grown through acquisition, and a lot of that acquisition is funded through debt, and that's driving the all of that interest payments that we saw on the income statement. They're probably going to refinance that debt, and we'll check that in the cash flow when we look at it. The only other thing to look at is obviously things like we got this deferred tax liability, so that's quite a big number. Otherwise, nothing really to kind of get too worried about. The equity, they got a nice positive balance sheet, 78 billion, and predominantly funded through these retained earnings. So there's the retained earnings, and then up at the top, this is what's been actually issued, invested by the shareholders. So they're not doing any equity funding. You can see there's no difference between these numbers here, and it looks to me like they are probably paying out dividends, which we can confirm now. So balance sheet looking reasonably healthy. I guess, as I said, the only kind of question mark would be the current assets versus the current liabilities, but they've got quite a lot of cash. It just looks like they're slow payers. So if you are using this analysis to assess the kind of payment terms, or whether you want to do business with these guys, make sure that you've got strong cash flow when you go into the negotiation. Here we see the movement in equity, and just a thing we're really focusing on let me just change the color so we can see this. So we're focusing on this column here, which is the retained earnings. So what you'll notice is last year there was a dividend of about 4 billion, and if we just scroll down a little bit to see this year the dividend, so there's still a dividend. In fact, let me just move this onto the screen so we can see that. There we go. So there's still a dividend, but the dividend has fallen to 1 billion. So real sense here that these guys, they've kind of like, maybe it's pandemic, they've kind of said, whoa, hold on a sec, we need to kind of, just stay off a little bit, and we need to make sure that we can actually afford that dividend. So significant drop in the dividend. Will it come back, or will they maintain it at 1 billion? Again, I'm not absolutely certain, but that is a variable income at the behest of the directors of the company. And so the final statement is the cash flow, and looking at the cash flow, good strong cash flow for this company. So here's the cash flow from the operating activities, 11 billion, down from 14 billion in the previous year. But again, some really good strong cash flows coming through. So underlying, it's a strong cash flow business. In terms of what are they doing with that cash flow, scroll down a little bit further, and again, that strong cash flow will probably be another part of kind of allowing them to operate at this low liquidity ratio, the low current ratio we saw earlier. We also notice in terms of the cash flow from the investment side, so this number here, this is the kind of the cash generated or the cash used in investing. You'll notice it's positive for this year, and the reason it's positive is because of the sale. There's the cash from the sale, so that they got $11 billion from the sale of their Australia divestiture, and that's part of the reason why the income, the turnover has come down, and it's also shown as a profit on disposal in the income statement, and it also reflects as to why they've got so much cash. And then finally, we can see down the bottom the kind of the proceeds from borrowings. So this here we can see that they are actually they're raising money, they're repaying money, so their debt is going down. You notice the difference between those two. So they're trying to reduce their debt, pay a little bit of dividends, and so they're using some of that cash generated. Not only are they actually ending up with cash in the bank, a decent cash balance, but they've also been using it to pay down debt. And I think that kind of makes sense, because it looks, the debt looks quite high, especially that 6 billion of interest if you're only making 9 billion of operating profit, or even if it's 12 billion underlying operating profit. You wouldn't really want to be going much more than that, because it becomes a little bit higher risk, if that makes sense. So really, from the financial perspective, nothing to see here, I think, is kind of the answer. That there's nothing really jumping out at me. There's nothing sort of saying, oh gosh, here's an issue. I'm pretty confident that they're operating within the right levels of the working capital. I think they've got probably a little bit more than half an eye on the level of debt. I think that they are, that they're just restructuring their business in order to kind of, take advantage of, the sort of the new post-pandemic world, perhaps. So you mentioned the share price. Let's have a look at how it's been going. So, as you mentioned, it's kind of gone all the way up and all the way back down again. And even in the last, in the last year or so, it's been bouncing around a little bit. So we're interested in the market cap, 79 billion. Don't forget that when we talk about that 79 billion, the net asset value of this business, in terms of the size of the balance sheet, is about 78 billion. So you're kind of looking at, you're paying almost bang on the net book value for this company. So in terms of the valuation, the net book value, there's no goodwill in that, if that makes sense. So you pay 70 or you pay 80 billion is effectively what it is there. You're paying 80 billion for a company which has net assets of 80 billion. Okay, and so that, as a general rule, that says this is a good potential. The PE ratio, that's the price to earnings, 20 times earnings. That's it's not cheap. It's not overly expensive. I think the US market as a whole is trading on a 30 times PE ratio. So 20 times, think about that, just flip it upside down and you get the yield. It's about a 4% yield. And I think that potentially this is might be an opportunity, looking at where the share price is right now, where it's been in the past, and thinking about where it can possibly go in the future. This certainly isn't one to avoid, let's put it like that. So maybe it's something to buy into. Again, you're not going to see I don't think you're going to see a 20 bagger or a 50 bagger. This is not your kind of your kind of shoot for the stars and retire early kind of one. But this might be once again a small part of a well-diversified portfolio, if that makes sense.
Yeah, makes total sense. And I thought what you said was about the trade receivables was very interesting, because we have a lot of viewers that don't just look at our videos for investment purposes. They also look at this in terms of understanding business acumen, raising their business acumen, learning how to read financial statements, because they're thinking about doing business with some of those companies. So I thought that was very interesting, especially if you're seeking to do business with them. You need to kind of be aware of the fact that they're going to insist and demand longer payment terms, right? So that's going to be important. Yeah, great analysis. As Ted mentioned earlier, one video that we recommend you look at as a comparison would be BrewDog. Obviously a much smaller brewing company, but certainly will give you some good comparisons, some good context from another drinks company. And again, don't forget to like, share, subscribe. And until the next video, thank you, Ted. Thank you, everyone else, for watching.
Good to see you, Moe.